Welcome back to The Resilient Economy, the podcast dedicated to turning financial confusion into clear strategy. Today, we're diving deep into a topic that causes genuine, palpable fear for millions of people in volatile economies around the globe: the sudden, brutal surge of the US dollar. This is what some call exchange rate panic, and it can feel like your financial life is spiraling out of control overnight.
That's exactly right, Alex, and thank you for having me. I've spent decades as an analyst and professor watching this happen, and the emotional response is always the same: a state of financial vertigo. People, driven by FUD, fear, uncertainty, and doubt, make impulsive, often wealth-eroding decisions. The panic itself becomes the worst advisor.
That's a powerful point. We're conditioned to panic. So the purpose today isn't just to explain why the dollar surges, but to give our listeners a practical mental toolkit to handle it. We want to transform that fear into a controlled financial action plan. The currency tsunami, understanding the mechanics. Let's start with the basics, Ben. When we talk about the dollar's skyrocketing, what are we actually seeing in the economy? It feels random, but your research says it's anything but.
Exactly. A sudden dollar increase is never random. It's the visible manifestation of deep systemic tensions. Think of the dollar not just as a bill, but as the anchor of global trade. It stabilizes debts, commodity prices, and the cost of nearly everything we consume.
So it's the gold standard that everything else is measured against.
Precisely. And I like to use a simple tide metaphor to explain the mechanics of devaluation. Imagine your local currency is a small boat in a port. The dollar is the safe, solid harbor everyone rushes toward when they see a storm approaching, a financial crisis.
I like that image.
When the dollar surges, it's as if the tide is rapidly receding in your local port. The water, your local currency, withdraws quickly, because the demand for the safe harbor, the dollar, increases exponentially. You have large investment funds pulling capital out of risky markets like yours. Importers need more dollars to buy their next shipment of goods. Even the average person starts buying dollars to protect their savings.
So it's fundamentally a confidence shock, the loss of faith in the country's economic future.
Absolutely. And this shock is triggered by a cocktail of factors reaching a tipping point. There are four major root causes listeners should look out for. Unexpected political factors, the black swan. A government crisis or surprise election outcome creates instant uncertainty, and uncertainty is the main driver of dollar buying. Low international reserves. If the central bank has low reserves, markets know it can't defend the currency. That's the ammunition indicator. U.S. interest rate hikes, the Fed. When the Federal Reserve raises rates, dollars invested in your country rush back to the U.S. for a higher, safer return, pressuring your currency down. Chronic fiscal imbalances. Uncontrolled public spending suggests the government will have to print more money to cover debts, which inevitably devalues the currency.
Wow, so the lesson here isn't just to react, it's to monitor the predictors, the Fed, the central bank reserves to anticipate the storm. That's a great takeaway for our listeners. The turtle strategy, personal financial defense. Once the storm hits, Ben, the initial reaction is to run and buy everything, but you propose something different. The turtle strategy, what is that, and why is discipline so crucial here?
The turtle strategy emphasizes discipline and resilience over speed. When a dollar spikes, the immediate goal isn't profit, it's survival. A turtle is steady, slow, and protected by a well-constructed shell. That shell is your prior planning. Your first move must be an emergency financial audit focusing on two things: dollar debts and cash flow.
Let's talk about dollar debts first, because that seems like the greatest immediate vulnerability.
It is. If the dollar suddenly jumps 20%, your dollar debt automatically costs you 20% more in local currency. My first action item is to prioritize the payment or restructuring of any dollar-linked debt, like mortgages or auto loans. If you can't pay them off, contact the bank immediately. Can you refinance? Can you switch to a fixed rate in local currency? Negotiation is your ally.
Right, and while your debt costs more, the The second leak you mentioned is inflation, because imported goods get more expensive.
Exactly. That's why you must immediately freeze all non-essential spending. You need liquidity to face the rising cost of basic goods, from fuel to imported food and medicines. Your cash flow needs protection.
And this is where the emergency cushion becomes the life raft. What is the ideal composition of that cushion during a currency crisis?
An ideal cushion covers 3 to 6 months of fixed expenses. In a crisis, the composition is critical. Local currency, keep only the portion necessary to cover your absolute immediate monthly expenses. Hard currency, dollars or euros, this acts as insurance. If you already held dollars, the surge is actually working in your favor. It's the most important goal of wealth protection.
That's a great illustration of why prior planning matters. You're saying don't run out and buy huge amounts of dollars during the panic. Try to have that hard currency already in place.
Precisely. The time to build the lifeboat is before the ship starts sinking.
Investments in stormy weather, safe havens, and opportunities. Let's transition to investments. Once the personal finances are stabilized with the turtle strategy, where do we look for shelter? The source material mentions 3 key safe haven assets.
Yes, when local currency loses value, you look for assets that have historically maintained their purchasing power. Physical gold or ETFs. This is the traditional refuge. Its value is fixed in dollars, so its value in local currency automatically increases with devaluation. The downside is low liquidity and storage costs for physical gold. Real estate, bricks, the value of land and property is usually indexed to the dollar. It's a physical safeguard, but it has very low liquidity. You can't sell a house in 24 hours. Cryptocurrencies, Bitcoin. This is the digital hard currency. It's decentralized and operates outside the local political system. The massive caveat here is the extremely high volatility. It's not suitable for short-term capital.
So the strategy isn't to pick one, but to diversify among them, depending on your risk tolerance.
Always diversify. A balanced approach means maintaining dollar liquidity, a small, easily bought position in a gold ETF, and only a tiny fraction in digital assets if you truly understand the risk.
That makes sense. Now, let's talk about opportunities. The dollar surge creates immediate winners and losers, correct?
It does. The winners are the exporters. If you sell goods or services abroad, you receive dollars that now exchange for much more local currency. Your profit margin dramatically increases. This is the opportunity to reinvest.
And the losers are the importers, businesses that rely on buying goods overseas.
Correct. Their replacement costs immediately surge, forcing them to raise prices or sacrifice margin. This leads to a critical practical reflection. Could your professional skill or business pivot toward exporting services? Think remote work, consulting, or software development for foreign clients. The crisis is a call for productive re-engineering.
That's a powerful challenge. One final investment tip from the article is dollar cost averaging, or DCA. Why is that so important when the market is fluctuating wildly?
Because in a chaotic market, trying to guess the bottom is pure speculation. DCA is about eliminating emotion. If your goal is to save in dollars or global stocks, avoid impulsive purchases. Instead, allocate a fixed local currency amount to buy assets regularly, monthly or weekly. This averages your price over time and reduces the massive risk of buying right at the panic peak. It's discipline defeating luck.
That leads us perfectly into the mind game. You argue that our greatest financial enemy isn't the exchange rate, it's our own mind in a state of panic.
Absolutely. A currency crisis is a test of emotional discipline. The biggest losses almost always occur when people buy out of euphoria, or more commonly here, sell out of fear. The noise is deafening. Social media gurus yelling, neighbors panicking. This FUD makes people rush to buy dollars at the highest price or liquidate long-term assets at fire sale prices.
You have a great analogy for this in the material.
Yes, a currency crisis is like a giant wave. The inexperienced person tries to fight the force of nature and gets tumbled. The experienced surfer, the one with discipline, positions themselves in anticipation and learns to glide over it. You have to be the surfer, not the victim.
So, how do we enforce that discipline? What's the concrete tool?
It's the 72-hour rule. When the market explodes, commit to not making any major financial decisions for the first 3 days. Use that time to read reports from authoritative sources, the IMF, the World Bank, not sensational headlines. By separating the initial emotion from the final action, you restore mental control.
I love that. Writing down your feelings of panic and then reviewing it 72 hours later. That makes emotion a data point, not a decision maker.
Exactly. And reinforcing the long-term plan. Remember your goals, retirement, education. Did those goals change? Probably not. The path may need adjustment, but the destination is fixed. Automation is the other key. If you already automate your savings, you've taken emotion out of the process entirely.
Practical application, the 90-day tactical plan. The emotional control is in place, the turtle shell